Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. Trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ross Kay, home ownership consultant at the wealthyhomeowner.ca. Welcome back to the show, Ross.
Hey, thanks for having me back, Jim.
Well, Ross, what a couple of days it's been. On Friday, some papers were announcing rising home sales across Canada, while other papers reported the opposite, while reading from the same press release. Now today we get a change to the stress test. What do you make of all this?
What I make of everything is the overwhelming continuation of false and misleading and deceptive information being communicated to the Canadian public that then in turn they rely upon to try to make a rational decision they're gonna be making payments for or covering the costs on for well over the next 25 years. It's just ludicrous, Jim. I mean, you do not see the stock market being talked about the same way that you see the housing market being talked about. What I mean to say by that is this. You don't see NASDAQ, Bloomberg, all of the major business media outlets reporting that the stocks dropped in price and then later and on another station, stocks increased. And then on another station, stocks decreased. And then on another station, stocks increased. You don't have a reporter sitting there with numbers in front of their eyes that shows the stock prices increased in the last month, and then hear the reporter say, oh, stock prices fell in the last month. But with housing, the single largest asset class in Canada, that's exactly what we see reported month after month after month. If you do a Google search based on the Canadian Real Estate Association's January housing report, their MLS system report that they issued on last Friday, you'll see one major news source reporting sales had gained, another major resource reporting that sales had fallen. You can't make this stuff up, Jim. You have one news report that reads seasonally adjusted data without understanding why seasonally adjusted data was created by the Canadian Real Estate Association for public consumption, stating that sales had dropped. Then you read another one who reports sales had increased because they were using the actual sales. Canadian Real Estate Association didn't clarify what actually their membership data said and which of the two numbers to look at. Because in their own report, they say the exact same thing. They say sales decreased on a seasonally adjusted basis, but they increased in real time, actual. And the home buyers are left out there wondering, who do we believe? What do we believe? I guess it depends on the news source that you're reading it in. Now we have today. We're already watching the news reports about the finance minister is changing the mortgage stress test, and they're now having these wildly different outcomes that are being forecast because of the mortgage stress test. You read through some of these news reports, these authors that are trying to sound intelligent. I mean, these people, I'm assuming, are paid well, Jim. They're the people writing on these items. I mean, they're being paid to at least do some form of critical reporting. But it's clear from what they have in their words, they have no idea what they're talking about. Here's a quote from today's paper. I think what's important for us to ensure is that we continue to protect people's most important investment. This was quoting Bill Morneau speaking with reporters on Parliament Hill today. Well, at least they acknowledge it's the most important investment in Canadian history, that being home equity. This will ensure that the people only take on mortgages that are appropriate for the situation, but it does not mean the changes in the stress test will be there if the average or the median of interest rates provided by the banks actually goes down or up. If you go back to our shows, Kim, from late 2016, when the stress test was being implemented or being talked about right out of the blue, and in the early 2017, you'll see on those shows, if you listen to our interviews, where I said Canadian banks, the stress test, the way that it's designed, is going to be circumvented by the Canadian banks and used against consumers. The reason why I could make that statement is because we have watched how the banks interact with their mortgage holders for the last 30 years. And they use the same strategy over and over again. And the strategy they use is, how can we squeeze a consumer to get as much mortgage interest out of them as possible? The original design of the stress test, as we recorded years ago in the podcast you still have online, was that the Canadian banks were going to use this to squeeze a consumer because it was a badly designed policy. The idea with the stress test was great, but it's the design of it which was flawed, because it left it open to be used by the banks to steal mortgage interest from Canadians, which is exactly what they did. So what you've actually seen happen today was you've had the federal government realizing that the Canadian banks manipulated the 5-year posted rate, which they were tying the mortgage qualification rate to. The banks used that to squeeze mortgage interest out of Canadians. So now the government has to go back in. They're still leaving the 2% increase, but now they're removing the bank's ability to use the posted 5-year rate against Canadian consumers. This has gone on now for almost 3 years. The federal government allowed the banks to squeeze Canadian consumers for 3 consecutive years. They didn't step in and revise the policy because it was flawed in the first place, because of their own ignorance to how the banks interact with their consumers, how Canadians interact with their homes, and how homeowners interact with their mortgage debt.
Ross, in an atmosphere of declining interest rates, why do we have this stress test at all?
Well, the reason why you have the stress test is nothing that's been reported anywhere in Canada today except what we've touched upon in the show. Canadian bankers are allowed to have, consumers are allowed to have a gross debt service ratio up to a maximum of 39%. Okay, historically, banks never used that 39% because a prudent number is between 32 and 36. You also have a total debt service ratio max of 44%, which means your mortgage debt plus your credit card debt payment cannot exceed 44% of your income. Now, what I'll tell your listeners is this. This is how ludicrous the politicians commenting on this, the policies that they're enacting, the damage that they're doing to Canadians, how extreme it is. I can tell you, Jim, that the peak gross debt service ratio that I ever agreed with home buyers accepting was 58%. There was a couple that I dealt with who showed me how they could spend 58% of their income, before tax income, on their house. And they lived a frugal enough life that I believed that they really could do what they said they were going to do, because they had a 5-year history of doing it on their previous home. That was 58%. Those people had no problem handling that. I have other families that I had sold to that were at 28%, 26% gross debt service ratios, and they couldn't handle the housing payments. They were the wrong people to buy the houses. Even though I had tried to protect them as much as I could by getting them to buy a lower-priced home, they still were not the people that should have been buying. And this is what's wrong with all of these stress tests. It's what's wrong with gross debt service ratio. It's wrong with total debt service ratio. The governments had to set, decades ago, a policy, a blanket policy that would cover everyone. Now, I can understand back in the days of the 286 computer, when a 286 laptop that ran DOS, that didn't even run Windows, cost $7,000, and meaning no one had a laptop or a computer at that time, where they couldn't use the granularity of data to offer a non-blanket gross debt service ratio. It's 2020. There are apps available that anyone can buy that you can plug in, and it can tell you what you should be able to spend in your income on something and what you shouldn't. Why do we have a blanket policy across all of Canadians? If you have a family that is a newlywed couple, first-time buyer, I have no problem with those folks going right up to the max of their gross debt service ratio if they don't plan on having kids for the first couple of years that they're in the house. I have no problem with that. If they're buying a brand new home, I have no problem that they would probably spend up to 40% gross debt service ratio on their home cost. If they want to buy a resale home, on the other hand, I may drop that down to 32%. And if they say that they're not using birth control and they're trying to get pregnant, then I'm probably going to drop them down to 28 or 26% on a gross debt service ratio. I am never going to allow anyone to believe this nonsense that a blanket gross debt service ratio or a blanket stress test in 2020 is even remotely appropriate with the granularity of data that is available today. Yet this is exactly what the governments are doing. And when they do it, they don't only do it, they brag about it. They brag about what they're doing. When in fact what they're doing is 80% of the population who is being impacted by these changes are being financially compromised in one way or the other. You're limiting the wealth building opportunity for some families, and then you're overexpanding it for families who shouldn't be placed in that level of risk. But that's exactly what happened. I mean, Jim, we just spoke here on the show today about the difference, the fundamental, basic difference between buying a brand new home and a home that's a 20-year-old resale. Those are two totally different purchases. Your calculation of gross debt service ratio has to be changed to be accommodative to those two different homes. If you have a condominium and it's an older condo or a newer condo, or in the case where you live, Jim, if it's a leaky condo or a potentially leaky condo, then you have to have a different calculation again. Where are the people in their life cycle? Are you newly married? Are you going to be married? Do you have kids? Are you planning to have kids? Are you going to have more kids? Are your kids teenagers? Are you paying for your kids' education? Are you budgeting for your retirement? Have your kids left the house? All of these different questions should dictate what gross debt service ratio is appropriate for those families, let alone what city you're living in. Because what city you're living in also impacts the gross debt service ratio that you should be taking on. Yet zero of that discussion has taken place. We have a gross debt service ratio that was created in the 1980s, still being used today. We have a mortgage stress test brought in that drastically reduced the gross debt service ratio maximum without telling the public that that's exactly what the mortgage stress test was all about. Predatory lending by Canadian banks. What I would ask your listeners to think about is this. There is a difference between needs and wants in housing. Every single Canadian needs to have a roof over their head. That is a primal need for every single Canadian. Everyone deserves to have a roof over their head. Now, that may be a one-room, in a boarding house. That may be adequate to satisfy the need. Once that need is fulfilled, then we're talking about wants. And it's those wants which need to have a rational discussion about. Because what's happening to the Canadian family is that artificially you have wants that are placed in front of you that you, over time, you gradually believe that you are needs when they're not. Not everyone needs to own a home. I hope everybody wants to own a home. I truly hope that's true, but they don't need to own a home. They simply need to have a roof over their head. Look, home ownership is wonderful. Home ownership gives you security. You're not constantly under the threat of a landlord telling you that you've got to pack up your bags and go out and find a new home. Every time a family moves, it costs them about 6 months of their time prepping and participating in the move. If they're independent business people, that is a loss of income that is substantial over that 6 month period. The reason why we're home ownership advocates is because of the security that owning a family home gives you. What's been going on over the last 2 days, both Friday and then today on Tuesday, because it was, of course, we had Family Day here in Ontario on Monday, is that once again we're seeing Canadians being misled, a press which is no longer performing any of the basics it used to perform, which was hold those issuing press releases accountable for what they're saying, and we have government who are still acting like it's 1980, who enacted a policy 3 years ago because they were so ignorant to what banks have historically done over the last 30 years to squeeze mortgage interest profits out of Canadians. We're here to stop this nonsense. We're here to expose this fraud that's ongoing because there's no need for it to happen. The only reason all of this goes on is so someone can stick their hand in your pocket, take your money out, your hard-earned money out, and stick it in theirs. No other reason, I'm sorry to say.
We'll have more with Ross Kay right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Ross Kay. Ross, CMHC has just come out commending the changes to the stress test, but they were also silent on what outcomes would result from it. Why are they so quiet?
They're quiet, Jim, because they don't know. They're guessing. They lack the basic understanding of how housing markets function and how home buyers interact with the home trade within the home trading infrastructure. They're clueless. They're led by a man who has a public statement that his mother made a 16% compound annual growth rate on his family home, over 30 years. It's bizarre what these people actually believe. CMHC came out and said, we agree with the changes to the mortgage stress test, and they give Bill Morneau a pat on the back for his safe speech today. Now, what we see is this. We see a government corporation who has been given hundreds of millions of dollars extra in the last couple of budgets to deliver housing initiatives across Canada. They have hired massive staffing improvement, yet they still don't understand anything about the mortgage stress test. They are clueless. How can a government, how can CMHC, with 40 years of housing data at their fingertips, housing data at the most granular level. So they have as much granular data outside of MLS system data that we do. The reason what we have more than them is we have the aggregated MLS data, Cooperative Listing Service data. We have that data. We've collected it for decades. We have it. We have the data that the Canadian Real Estate Association no longer has because they purged it from their records consecutively every single month over the last 40 years. But CMHC comes out and gives Bill Morneau a pat on the back. Instead, what they should have been saying to Mr. Morneau, look at this stress test, the way that it's designed, it was good intent, and we understand that the OSFI did this because of the predatory lending practices of the banks. But we have this methodology that we want to bring in and institute because that treats every Canadian equally. It treats every Canadian family uniquely. It creates an environment where there is no risk. It creates an environment where the most wealth growing is possible for a family through home ownership. They didn't do any of that. They just give Bill a pat on the back. Now, they're going to go back to their computers. They're going to go back to their little groups. They're going to go back to writing reports. They're going to go back to writing housing market reports that are just such gobbledygook. You can debunk them in 30 seconds when you first read them. And they're going to get their hundreds of millions of dollars, and they're going to have their nice cushy jobs because they can't get laid off. They're going to collect their great pensions, and the Canadians are sitting out there looking for answers, but CMHC isn't too incompetent to supply them. Now, this is not a criticism of the people themselves, Jim. This is simply an example of when you don't know something, admit it. I'm not going to come in on this show here and tell you whether or not someone should buy GM stock or Ford stock because I am unqualified. I am ignorant to how those two companies need to be understood to be invested in. I will tell you that I believe in the Warren Buffett model, that the safest investments are buying companies that sell people the necessity. They meet people's needs, not their wants. You are going to get rich on the wants, and you can sustain yourself in the needs. What I know from my perspective is this, because when I first started in sales, one of the very first sales courses I took was Brian Tracy. He's an old sales trainer. I don't even know if the guy's still around. And he had this seminar called the Phoenix Seminar, and it was for salespeople. And it was a self-motivational seminar. It was, something everybody can laugh all you want. And it was a very good thing to take, especially as a young guy in my late 20s. But in that seminar, he explained about being a salesperson. And he defined it this way. People, if you are going to sell someone what they need, you're never going to get rich. You are never going to get rich as a salesperson simply by meeting someone's needs. You get rich by selling to their wants. And you get even richer if you're able to create the wants of those people to such a degree that want becomes a belief. They believe they need what they actually want. My dad, one of the best salesmen, if not the best, real estate salesperson in the history of Canadian real estate. This is how good this gentleman was at sales. We would be out looking at houses at agents' open house. So they have open house where the agents can go look, the real estate sales reps can go look at the new listing. My dad would get back to the office, pick up the phone, and would call one of his old clients. This would be someone he had never talked to before, or hadn't talked to in a couple of years. They hadn't called him and said, "Hey, Alan, we're looking to buy a house. We want to trade up to a bigger property. Can you start helping us looking?" No. My dad saw a house, and it registered for him what of his past clients would be suited to this property. The property would have been extremely well priced, in extremely good condition, in extremely good street, where he knew that his old clients, if they bought it, were going to make the best gains. And he believed that would have been in their best interest. He would call them up and he would ask this question: "Hey, Shirley, is Bob home?" Shirley may say no, he's at work. Or Bob may say no, Shirley's at work. Dad would say, "You got 15 minutes?" And they inevitably would always say yeah. Before they got a chance to change, he would say, "Well, throw your coat on. I'll be over to pick you up. I got something I want to show you." He would drive over to their house, pick them up, drive them over to the house, show them the house. Between that entire episode, they magically wanted that house. He would drive back, book the appointment for later in the afternoon when both spouses were together, or later that evening, show them the property, and the next morning he would have their home listed for sale in preparation of them getting ready to buy that house because of want. He was a salesman. Now, he loved his clients. He cared about his clients, but he was still a salesman. He knew about wants and needs. CMHC doesn't understand that the only reason people will extend themselves too much when buying a home financially, extend themselves financially too much when buying a home, is because they want something they haven't rationally thought through. They haven't sat down and rationally thought through, do I really want this, or is someone else telling me that I want it? I know my dad told the people, hey, you want this house. You want to make this move. Over a very short period of time, occasion after occasion after occasion after occasion, I would see him selling them that exact home. Or, if that home sold before their property had sold, he would go find them another one. And they weren't necessarily even listed on the local MLS system at the time. He would go find them the right home because he knew what they wanted. He was a successful salesman, the top-ranked salesman in Canada for 7 years in a row because he filled people's wants. CMHC is there to fulfill people's needs and protect them from what they may want without thinking about it.
We'll have more with Ross Kay right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, a listener asked, I was wondering, is it better to buy a starter home now and trade up later, or is it better to save up and buy a more expensive home in a couple of years?
Oh, there you go. Well, that goes back to both of the first two parts of today's show, Jim. Both of the first two parts. So my answer to this listener is this. Look, you are unique. Your home buying experience or your home buying profile is unique. What is right for you will not be right for someone else. What is right for someone else will not be right for you. A blanket answer is not possible. The answer coming from someone who earns sales commission income also is not going to be the correct one, because there is always going to be an underlying premise that I need you to buy a house so that I can pay my own mortgage. So what this listener is asking is there a blanket rule for how you should enter a housing market and work the property ladder? And our answer is no. The same way that there should not be a blanket rule on mortgage financing, or CMHC should not be allowed Canadians to think that it's a one-size-fits-all when it comes to mortgage financing or even home ownership. What this listener needs to do is they need to sit back and work through the process. Should they be a homeowner in the first place? Now, I will tell your listeners this. I'm assuming over 90% of the Canadian population, there is no way that you are ever going to be prudent enough with your money that you're going to be able to rent a property for your lifetime, invest the rest of your money in something else, and come ahead the same way that you are going to do through home ownership. I have never seen it happen. I have known some extremely frugal homeowners over the years. You know, we talked about it early in the show. It's just the odds are so stacked against you. Human nature is so stacked against you. I just think it's a foolish premise to to try to even to attempt. I can also tell this listener that all of the sales versus rent comparison videos that you see on YouTube, they're all hogwash. They're all nonsense. We can debunk every single one of them, even one by great Canadian well-known financial experts. We debunk them all with data. They don't make sense to us. Should you enter the property market now? Well, first of all, what market are you buying in? This listener. What category of home are you buying? What is your age? Because where you are, age-wise, like where you are in the demographic mix of the country and of the city and municipality looking to buy in, will impact that, what your timing decision should be. What type of a home are you going to buy? Are you going to buy a new home or a resale? Talked about this earlier in the show. That's going to impact the recommendation that you should be given. We're going to say, is your goal to become as wealthy as you can through owning a home, or is it simply so that you don't have to worry about moving? Do you have debt that you have still outstanding from student loan? Is your car suitable for the commute that you're going to have to take as you travel to work? Have you budgeted for insurance changes? Are you married? Are you going to have kids? Do you have a special needs child? Because I mean that throws another part of the equation. All of these things can be answered, and all of these things you can sit down and look at and make a rational decision about when you should be entering the market. Then you also use timing the market. So the category of home that I'm looking to buy based on the municipality that I want to buy in, based on the 3 to 4 year window that I could safely look at, is that for me in that situation, should I buy a home now or should I wait? Because your timing the market makes a massive difference. The average home trader who works their way up the property ladder that started in 1985 till today, looking to exit the market, by simply timing the market, you're going to have an extra almost $200,000 in the bank. Why not approach it the exact same way now? What I can tell your listener is this. Look, there is a no one-size-fits-all product available for something that is going to consume the largest amount of your income over the next 20 to 25 years than anything else. You are going to spend a higher percent of your annual income over those 25 years on your home, no matter what anyone tells you. That's what's going to happen. Why not do that in the best way possible? Why not save every penny you can? Why not grow your wealth each 0.001% higher than you can? Why? Why not? Because it's possible today. It's 2020. It's a different world. The data is available so that you can make a rational decision when the information is placed before you. You only need to see it presented to you in a way that makes sense. In other words, if everything that I said that made sense in the first two segments of the show makes sense to you, well, yeah, I can understand why someone buying a brand new house can actually spend more of their income on the mortgage payment than someone who buys a 20-year-old home is able to spend, because the new home buyer has a 5-year home warranty. The new home buyer probably is not going to have to spend anything fixing up the home for the first 12 years. Anything that they're going to change to the home was because they want to change it, whereas the 20-year-old home, there are things that are going to need to be changed during that same 12-year period. I can't give this listener the answer they want without understanding exactly what their situation is, because there is no blanket answer possible. Every single Canadian household is unique. What you can do is draw upon the experience of those who have gone before you. You can draw upon the experience of families who have already traversed the property ladder over their lifetime of home ownership. You can use that information to make your own decision for yourself that are in your own best interest. I only ask that you get out there and you find those answers to the question that you need answered before you move forward.
Ross, I just saw a headline on social media that asked, is the Toronto real estate market entering the same conditions it had in 2017?
Oh my, Like, these people are insane, Jim. Like, these people are nuts. If you go to our shows on the podcast, okay, go back and listen to the old podcasts in the fall of 2016, okay? Listen to those podcasts where we warned peak price was going to be hitting in the spring of 2017, okay? We know this because of how a housing market functions, okay? We measure housing markets differently. So let me explain this to your listeners. In the spring of 2017, okay, in the spring of 2017, or the fall, the fall of, spring of 2017. I'm looking at my fall numbers to make sure that I'm looking at my fall 2016 numbers because that's how we forecast for the spring of 2017, okay? I'm just telling how we do. Right now, when I'm looking at, okay, in the spring of 2017, January of 2017, in the Toronto housing market, it was 300% hotter price change than it is today. There is no comparison between 2017 spring and 2020 spring. There is no comparison in terms of how much house price illusion is going to be reported by the local real estate boards. It is a mathematical impossibility for that to happen because of the amount of mortgage debt that would have to be booked immediately in the next 2 months is impossible to get booked. It is impossible. The trading rate is not there to support it. You are looking at a run-up of, oh my word, we are basically back to 2013 levels trading rate, not even 2013 trading rate. We are going back, oh my word, how far do you have to go back for the Greater Toronto market? 2009, okay? So the trading rate, which is a metric you don't see produced anywhere, Jim, which is the only metric, well, not the only metric, it's a primary metric that every housing market needs to be recorded, be tracked, is way back to 2000 and 2009. What are these people talking about? The housing market was three times more house price illusion was being built in the spring of 2017 than until today. It would take almost 2 years of gain for the housing market to reach the levels. So in other words, it would have to continue forward at a constantly accelerating pace of sales for the next 2 years before mathematically, now when I say mathematically, I'm talking about mortgage math, okay? You would take 2 years before enough mortgage debt could be booked to reach 2017 peak house price illusion. 2 years. The Bank of Canada could not handle that. Our debt to income level, it would have to increase so much. There's no bond rating agency in the world who wouldn't be downgrading Canadian bonds. It is a real estate talking point released by organized real estate, believed by the world. The world actually believes 1 + 1 = 3 from a housing math perspective. The world believes 1 + 1 = 3, where any child in grade 1 knows 1 + 1 = 2. It's only in the world of housing, the largest asset class in the world, where this phony math is believed to be true.
Is that true? Ross, they're saying there's a shortage of homes for sale and that's boosting prices in Toronto. Is that true?
No, there isn't a shortage of homes for sale. Look at an MLS system. The real estate brokers who work at a cooperative listing service, there is a constant imbalance between supply and demand because supply and demand is not measured the way that organized real estate measures it. How do you explain that, Ross? Look, if you take the median selling price of a home in a municipality, so let's say Canada, the median asking price for a Canadian home today is $375,000. Okay, an ultra luxury class home, that means, is worth about $1.2 million. Now, this is a mathematical calculation. You calculate what is your ultra luxury class housing stock using a mathematical calculation. Across Canada, It's about $1.2 million. I'm not going to tell you what the exact number is. It's about $1.2 million. Now, but people in Vancouver say, well, Ross, a single detached home the cheapest single detached home in Vancouver is $1.2 million. Yes, on a Canadian-wide basis, that is an ultra-luxury class home. Vancouver is Beverly Hills. Toronto is Beverly Hills. In my city of Burlington, a regular person doesn't believe that they have a right to own a home in Roseland, which is our old neighborhood in Burlington where, the old estate-type homes are found. The average family in Burlington does not believe they have a right to own a home in Tyandaga, the modern upper-class, ultra-luxury class homes in the city, or Millcroft. The average Burlington family doesn't believe that. Why? Because those are the most expensive areas. It's the exact same thing province-wide in British Columbia and province-wide in Ontario. There is not a right for every Canadian to live in Beverly Hills. Vancouver is the Beverly Hills of British Columbia. Toronto is the Beverly Hills of Ontario. You are never going to give everyone in the province the right to move into Vancouver or the right to move into Toronto. Just because your parents were born there or you were raised there doesn't mean you have a right to stay there. Now, I am the biggest advocate you're ever going to find for growing the housing stock. Okay, my answers to this is a great question which you brought up, and I know the show is going on long today. Ross, what kind of homes should CMHC be focusing on financing or have all their initiatives being focused on? And this goes back to the earlier questions we had in the show, needs versus wants. Should CMHC be focusing on needs, the need to put a roof over your head, which is what CMHC has been focused on since Evan Siddell took over his role there? Is that what they should be focusing on? Or should they be focusing on wants? Should CMHC actually be focusing on ultra-luxury class homes or luxury class homes as their primary housing stock growth? Is that what they should be focusing on? Well, I'll tell all your listeners this. Right now, CMHC is focused on putting a roof over people's heads. Needs. Their focus is creating a supply and demand imbalance for the future. If CMHC instead had been focused or switched to focus on building $1 million, $1.2 million, $1.6 million homes in the Greater Toronto area, what's going to happen is you're going to have families who currently live in luxury class homes move to a brand new ultra-luxury class home. Their home is now vacant. The family currently living in an executive class home moves to that vacant luxury class home. The family who's living in the family home moves into that executive class home, which is now vacant. The family who's living in the townhome, either a primary or a secondary trade, or their first home, moves into that family class of home. Their townhome or their condo is now vacant. Now, the people who are entering the housing market at the bottom of the property ladder have a vacant property to move into. CMHC would have fulfilled the dreams and desires of 5 families by building one ultra-luxury class or luxury class home. When they build a need property, shelter, put a roof over someone's head, they're only solving one problem. They are leaving the other 4 problems unaddressed. Those other 4 problems create just as much financial fallout for the economy that than that one family or that family in need face. Because by allowing people to move freely through the property ladder, you never have a problem with affordability. You only have these problems when the government constrains people's movement up the property ladder. Data, not opinion, data proves this to be true. But when CMHC, the government, the population at large, believes the talking points of the Toronto Regional Real Estate Board that the housing market is set for a run-up, the same that it was in 2017, you're never going to have proactive solutions result. You're going to have bad policies enacted, poorly designed mortgage stress tests. because you didn't plan for the banks to capitalize on a loophole you left in the system. You didn't look at how can this policy be attacked. See, Jim, how we look at things is this, because I had to look at this for my business career as a salesperson for 30 years. How is someone going to attack my business? How can I be attacked? How can, when I'm out on a listing appointment, competing for a listing, what are my competitors going to say against me? What are they going to use against me to win that list? You have to look at things from how you can be attacked. When the government enacts a policy where they haven't looked at every possible place that policy could be attacked by stakeholders who want to fill their pockets with the consumer's dollars, that policy will be attacked. You were reading something about the Toronto housing market that was hogwash, nonsense, mathematically impossible, issued by the Toronto Regional Real Estate Board in order to generate extra sales this year for their members. There is always, the way that real estate is bought and sold with the real estate brokerage naturally creates the illusion of supply and demand imbalance. That's what is a consequence of dealing with real estate brokers. Real estate brokers need to have that imbalance in order for them to make commission. Because when that imbalance is not there, it's way more difficult to make a sale. So they have evolved over the last 40 years methodologies, strategies to create the illusion of supply and demand. Instead of answering it this way, for every single house that you see for sale on the Toronto Regional Cooperative Listing Service, I will tell you there are 5 more homes that you can walk out tomorrow and buy. What I will also tell you is it takes a tremendous amount of work to uncover those 5 homes. But in 2020, when you're paying $20, $30, $40, $50,000 in buyer broker commission, I don't think anyone will have a hard time doing the little bit of hard work that's needed to earn that kind of a single sale commission.
Ross, thank you so much for putting in all the time today.
Hey, thanks for having me on, Jim. My
guest has been home ownership consultant Ross Kay from the wealthyhomeowner.ca. If you have any questions for Ross, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.